Hey everybody, this is Greg Gossett, and today is Saturday, November 5th, 2022, and thank you for coming to and listening to another edition of the Gossett Trading and Mentoring Weekend Review of my trades. I hope you're doing well. I hope you had a good week last week. I hope you're having a nice weekend, and just appreciate you coming by and spending the time, and hopefully this podcast has been helpful for you and will be helpful for you today. So this is the plan. This is the format for the podcast. First of all, we are going to run the U.S. legal disclaimer. Secondly, we are going to come back, take a look at the current positions that I have, open ones, closed ones, all the trade activity that I did last week. Again, talk about when I bought them, why I bought them, how I'm going to manage them moving forward, most importantly. And hopefully it gives you an idea of how I view the market, how I look for good risk to reward ratios, set proper emergency stops, end of day stops, trailing stops, so forth and so on. So was another crazy week last week with the Fed, with their announcement. Man, we had that head fake where we went up and then just complete destruction to the downside when Fed Chairman Powell spoke. So interesting market, super volatile, very, very tough to trade, but good experience for us all in trading in these volatile markets. And hopefully we will get a time where the market can have a sustained up leg. Wouldn't that be nice? Wouldn't that be ironic? But in the meantime, we have to trade what we have. We have to deal with the hand that we are dealt. So after we go through the current positions that I have, we're going to switch gears. We're going to talk a little bit about trader psychology. Always the most important part of trading is the ability to control your emotions, not let them get elevated, amplified, and to be able to follow your process. After we do that, we're going to talk, or I'm going to do a poem for my good trading poet friend Frank, and he always writes great poems every day, and I'll give you his Twitter handle when we get to that. Hopefully you'll follow him, and the poems that he has are just wonderful, and they're always pertinent to what's going on. After that, I have gone down through my entire watch list. I've gone down through both on the daily charts and the weekly charts. I've started incorporating the weekly charts because there are so many great trades sometimes on the weekly bars, but keep in mind weekly bars close on Friday, so I'm not going to make any decisions until next Friday. I did take some weekly trades yesterday, Friday weekly trades as well. You know, it was interesting. A good friend of mine and one of my coaches and mentors, Steve Burns, on Twitter, did a poll of what time frame that he was asking traders what time frame works best for them. And I actually went back through and looked at my results. And honestly, over the last 28 years that I've traded, weekly time frames have been the most profitable. There's no doubt some of the biggest trades I've ever had are on weeklies, and there's some nuances to weekly and monthly trades that are nice, because if you're position sizing correctly, you're buying fewer shares, of course, because the range during the week or a month is so much larger than it is during a day, and so you have to position size smaller, and it just kind of drives the point home. When you trade smaller, you trade better. And you know, when I have a weekly trade or a monthly trade, I rarely look at it. I really don't care, and I think it tells us that the least you care, the better in trading, honestly. And you know, when you're trading on the dailies, of course your position sizes are higher and you care more, and you're more apt to get in there and mess around with it. Obviously, same with day trading. So glad Steve asked that question, and glad I took the time to go back and look. But that's why I have incorporated weekly trades, my weekly trades, into this podcast, so that you can follow what I'm doing and get an idea of the great risk to reward ratios that you can have on weekly and monthly trades. All right, so I have a list of dailies that I'm looking for next week, and I'm also have a list of weeklies that I'm looking for next week, next Friday. So first of all, before we get started, I have to run the U.S. legal disclaimer, so let's get that out of the way. Hang tight, and I'll be back in about 40 seconds. Thank you. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here, and here. Thank you so much. All righty. Well, I live in Utah, and boy, cold day today, snow. Oh, the winter has arrived. Ugh, not really my type of year. I like warm weather, hot weather, and I guess I'm going to have to wait till about May or June to get that. But I will definitely make do. I'm thinking about going to Mexico for 2 or 3 months or 2 or 3 weeks sometime in November or possibly in December, just so I can get into the warm weather again. So maybe I'll be doing the podcast from Puerto Vallarta. That's where I'm looking at going. So excuse me. All right, let's get started on some of the daily trades that I have. Here is AMD. AMD, I did buy AMD back on the 17th of October with a simple little under 30, over 30 RSI, under 30, over 30 RSI. Of course, I always place my emergency stop 2 ATRs below. And then I also have an end of day stop. And when I get into the new positions that I've taken this week, I'll go through that in detail, but just wanted to point that out here. So always an emergency stop. So I have my trigger. My entry trigger was an under 30, over 30. I placed my emergency stop 2 ATRs below. And then I also have an end of day stop because I took the price with an under 30, over 30. If it closed below 30, I would go ahead and get out of the position. So I simply took the trade at 57.51, and it moved sideways for 1, 2, 3, 4, 5, 6 days, and finally had a nice little up move here. I always take a partial profit from the previous day's close. I take 10% partial profit of whatever position that I have if it moves 0.45 ATRs from the previous day's close. And you can see I bought it here at 57.71. The next day it gapped open and I took 10% off. And then here I took 10% off. Here I took 20% off. And I really like to sell a portion of my position into strength whenever the market wants to give me a little profit. Not the entire position, but just a portion of the position. I always like to play offense and defense with my trading, just like any good sports team, right? Defense is end of day stops, emergency stops, trailing stops, but taking profits from when it moves 0.45 ATRs from the previous day's close, that's my offense. So I really strongly believe in trading that you have to play both offense and defense. I also have the orange line up here. This orange line is exactly 1.5 ATRs from my entry. So whenever I buy something, I place my emergency stop. I know where my end of day stop is. I place my 1.5 ATR trailing stop level. 1.5 ATRs means it's 1.5 average true range from the entry, or in other words, it's moved outside of noise. Anything within 1 ATR would just be considered noise, but once I move 1.5 ATRs outside of noise, then I go into trailing stop mode. So in other words, here on the 25th of October, it did touch my 1.5 ATR trailing stop mode, which means going in the future, if I ever get a close below a previous day's low, I'm going to get out of half of my position as a defensive maneuver, right? And that happened here on the 27th of October. You can see this bar closed below the 26th low. So on that portion, I made, what was that? 1.66%. Now, the reason I like selling half, if it had continued to come down, I would have been very happy that I had sold half at a profitable level, right? But if it continues up like it did, I'm still happy that I have half of my position. So selling half is one of the best maneuvers for me. It's a win-win situation. Like I said, if you sell half and it goes down, you're glad you sold half. If it keeps moving up, you're still glad you have half. So it's a very important part of my trading. So under 30, over 30, maximum allowed emergency stop, end of day stops, just the opposite of why I took the trade. Under 30 goes to over 30. If it closed under 30, I'd get out. Did hit the trailing stop level, had a close below the previous day's low, got out of half. And right now, it is moving up just nicely. And the rest of the particular trade here, the second half that I still have, is up 7.06%. Verizon. Okay, Verizon, I am out of Verizon, and I'll tell you why. how I set this trade up. The trade was a under 30 over 30, also a rejection of the negative third ATR channel, also a double bottom with the bullish divergence and a missing right shoulder. So I took the trade with the under 30 over 30, placed my emergency stop. My end of day stop would have been a close below the 30 RSI. As it moved up, I continued to take partial profits, as I just mentioned. Here on the 27th, I got to my trailing stop level on the 27th, closed below halfway of the previous bar's low, sold half, locked in a profit of 2.43%. Next day went roaring back up. Again, glad I still had half, right? Took some profit targets here, took some profit targets, took some more profit targets here. And then on this day, I got out because it went above 50 RSI and closed below 50 RSI. That's another one of my rules. And this is probably a good time for me to mention this. So in this podcast, I tell you what my rules are, but they may not make a lot of sense to you because I have a lot of rules, right? The majority of my trading is based upon having a lot of exit rules on if it gets this high, sell half here. If it does this, get out here. And I do teach this all in my private one-on-one course, the private one-on-one course that I teach in the evening time via Skype. I'll talk about this at the end of the podcast if you're interested. But it's a great way to learn. It's a great course. It's one-on-one. It's the best way to learn anything is one-on-one with your instructor. And in that course, I go through ad nauseum the rules. So, here I'm trying to tell you in this podcast what the rules are, but we don't have the time to just really get into all the nuances because there are a lot of rules. But if you become my student, trust me, I'm not going to let you go as my student until you know all the rules by heart. But under 30, over 30, got to trailing stop level, took profits along the way, closed below the previous day's low, locked in half at 2.43, continued up, continued to take profits as it moved up. And then on the 3rd of November, it went over 50 RSI, under 50 RSI, and I exited the rest of the position for a gain of 4.96%. All right, so those are the dailies. Let's go to the weeklies. Weekly, I did take a weekly trade on IWM. That's the Russell 2000, the mid caps. My entry on this here was an intra-week rejection of the 300-week moving average. This is the orange line here. You can see during the week we went below it, and then at the end of the week, we closed above it. Of course, I always place my emergency stop 2 ATRs below. My end of day stop, my end of week stop in this situation would just have been simply a close below the 300-week moving average. You will hit your emergency stop on occasion, historically, statistically, only about 5% of the time. But it's important that you have it there. You have to have your emergency stop. And when I go through the new positions, I'll show you exactly how I did that. But thankfully, it held above the 300-day moving average, continued to move up nicely as it moved up. Of course, I took partial profits, as I mentioned. Moved up for a nice couple weeks. Boom, boom. Last week got up, or 2 weeks ago, got to the trailing stop level of 182.20. So now I am in trailing stop mode. Now, just because you get to trailing stop mode does not mean that you sell half, right? I'm at trailing stop mode, but I'm still looking for a bar that closes below the previous bar's low. So if this coming week closed below the low of last week's low, what would I do? I would sell half, right? That's exactly what I would do. I would sell half, but it has not. So I'll just stick with it. I'm still bullish until something tells me to get out. This particular trade so far off of its highs, but from entry to exit, it's up 6.45%, which is pretty sweet. Microsoft. All right, Microsoft is a new position that I took on Friday, yesterday. And why? Well, very simple. Do you see how it bounced at the 200-week moving average? That's the level that I identified that there should be some buyers coming in. I didn't take it for granted. I wanted the price action to show me that it was going to be supported there, and it was. You see how it just came down, tagged it, and bounced? So that's it. So this is a brand new trade. Let me show you exactly how I set it up. So first of all, I have to look for the setup. Yes, okay, it bounced at the 200-day moving average. Now, how many shares do I buy? Probably the most important thing in trading is what your position size is. So let's just use a hypothetical $50,000 account today, right? So if I had a $50,000 account, my maximum allowed loss on any one trade is just 1%. So 1% of 50,000 is $500. If you had a $100,000 account, 1% would be $1,000. If you had a $25,000 account, it'd be $250, right? Doesn't matter. The math works the same. But in this case, let's just assume that we have a $500,000 account. 1% of that, how much? $500. I take the 500 in this case, I divide it by the value of the 2 ATR. 2 ATR basically means 2 standard deviations, or 2 times the average range to get me outside of noise. Take 500 divided by 34.10. Basically tells me to buy 14.66 shares. I just round that up to 15 shares. So in this hypothetical, I would have bought 15 shares. 15 shares, if it moves $34.10, which is the emergency stop down here, how much would I lose? $500. Now, where's my end of week stop? Well, I purchased this because it bounced at the 200. If it just next week on Friday, if it closes even 1 penny below the 200, I'm going to get out. Will I lose 500? No. Right? I'm only going to lose 500 if I get to my emergency stop. So as long as it stays above this 200-week moving average, I will continue to be bullish and stay long on the Microsoft trade. Of course, up here, I have the trailing stop level. Once it gets up there, I'll go into trailing stop mode, but I'm not there yet. So I'm not in trailing stop mode yet. So the most important thing I'm looking at right now, the only thing I really care about right now, or the only 2 things I care about are, 1, next Friday, if it closes below the 200, do I get out? Yes, I do. If anytime next week it gets down to my emergency stop, I get out. I don't wait for the end of the week. If it gets there, it's an instantaneous situation. All right. I always like to focus on the risk first, and the risk is the emergency stop or the end of the day stop. Once we get into trailing stop mode, then it becomes a different thing. Then I'm more into the profit modes and securing those profits. So I like this trade. It's very rare that you can buy Microsoft at the 200 week on the daily. And I got in here at 221.34. It's 221.39. So basically it's slightly up just by 5 cents or whatever. And so we'll see what happens next week. But I like this trade. I think it's well thought out. I have all my levels there that are showing me exactly what I need to do. Also, double bottom bullish divergence on this this previous low here, deep red MACD bars. Of course, we have the rally in the middle with some green. Now we have come down. We are lower here than we are over here, clearly, but the MACD is not as deep here as it was deep here. So that's a double bottom bullish divergence. And essentially what that's saying, or what that's kind of insinuating, is that the momentum to the downside is slowing, insinuating that we may have a move back up. Maybe, hopefully, right? But I can't just bet on that. I just have to follow the price action. If price action closes below the 200 week moving average, I'm just out. That's it. Take a little loss and just get on to another trade in another market. GDX. GDX is another trade that I took on Friday. I don't usually take more than one trade, but I liked both of these, and they're in different sectors. This is GDX. This is the gold miners ETF. This is kind of an interesting setup here. Haven't talked about these lately in this podcast because we haven't had a lot of them, but this is something that I teach in my class. And by the way, if you want to learn more about V1s, V2s right away, you can just go to my YouTube channel. And in my YouTube channel, in the lessons playlist, I have V1, V2 entries, and they are a great entry. They give you precise reasons to get in. They give you precise reasons to get out. And the V1 formation makes sense to get long or get short, depending what's happening, and I'll show you why. So here we go. On Friday, I did buy GDX at 24.90. It's 24.95, so it's up a little bit. But you see the last 2 bars here. Here's bar 1, here's bar 2. Bar 2 goes under bar 1's low by at least a quarter ATR and then closes above bar 1's close. That is called a V1 entry. V2 entry, well, you can read about it, or you can watch it in my YouTube playlist video, but you can have a V1 or a V2. This is a V1. Now, that was the signal, and it's a higher low. In other words, this low here is higher than this low. I always like higher low entries, whether it's on the 200 or the 250 or V1s, V2s. Higher lows are always better because the people that bought down here, the people that bought the lows, that were lucky enough to buy the lows, once it rallied nicely, there's a lot of profit there, and they're kind of they're in a position where they have a lot of profit, where they're probably going to sell and lock that in. And that's usually why lower lows bounce and then come back down. But higher low situations tend to trend. That's why higher low entries, whether they're 200s or anything else, to me, in my experience, you have a better chance of a leg up than you do just buying a low and getting a bounce that fails, right? So bought here at 24.90. Let's do the hypothetical. Here we go. Let's do the hypothetical, right? $50,000 trading account, 1% is 500. 500 divided by the value of the 2 ATR divided by 4.89, or 4.19, excuse me, would tell me to buy 119 shares. Well, if 119 shares goes straight down, $4.19, how much do I lose? 500. See how that works? It's pretty nice. Now, that's worst case scenario. End of day stop on a V1 or V2 is different than a V1, than a 200 or 300 or 250 or an under 30 over 30. The key point for me is if I have a V1 entry, which this is, if the bar, if in the future, if we get a close below halfway of this particular bar, that's my exit. So if next week, if we close below 2360, I will get out of the trade. Okay, if it closes next Friday at 2360, I'm out of the trade. If anytime next week it gets to my maximum allowed loss of 2080, I will get out. But this gives me a small little potential risk here with the potential of a nice upside. And that's what's important in trading, is always your risk to reward ratios. And then of course I have my 1.5 trailing stop level up here. So higher low V1, place my emergency stop. My end of day stop is a close below halfway the washout bar. My trailing stop level is up here, 1.5 ATRs above. And slightly in the money on that. Bought at 24.90, it's 24.95. All right, Qs. Qs was a weekly trade that did not work out for me. If you remember, if you were watching the podcast, I did buy the Qs back here with a close under, close over the 200-day moving average. I bought at 275.10, placed my emergency stop. The week after, it held the 200, held above, so I kept. But you can see last Friday, we had the sell-off last week, and it closed below the 200-week moving average, and I had to get out for a loss of 3.85%. Of course, I have my emergency stop down here. It didn't get there. In the hypothetical, if it would have got down here, how much would I lost? $500. Here, hypothetically, I probably would have lost $200. And most of the time, 95% of the time, your end of day or your end of week trade is going to get you out of the trade. Now, going forward next week on the Qs, if we were to rally and close back above the 200-day move or 200-week moving average, I would re-enter the trade. But this one was a losing trade, had to follow my rules, loss of 3.85%. And then lastly, Intel. This is a trade that I took on the monthly. I like to trade monthly bars. I like to trade weekly bars. I like to trade daily bars. I like to intraday trade. But this was a trade that I took at the end of October, the last day of October, because we had a close under the 200-month moving average and a close over the 200-month moving average. I bought at 28.21. It's 28.20, down a penny. But it's the same thing, right? If at the end of the month, because that's when this bar will close, if it closes below the 200, I will get out, just like I did on QQQs. So emergency stop, I know where my entry was, and the level and end of month stop closed below the 200, I would get out. If we rally up to the trailing stop level, the orange line here, that's when I will go into trailing stop mode. So real quick recap. AMD doing well. Last part up 7.06%. Verizon got out of the trade because of my rules. Last one 4.9%. IWM on the weekly trade have the full position other than the scale outs, up 6.45%. Microsoft just barely took that trade right about break even. GDX on the weekly took that trade right about break even. QQQs on the weekly got out for a loss of 3.85%, and then the IWM monthly trade right about break even. All right, let's go and do a little trader psychology. This is from Tom Canfield. Great channel to follow on Twitter. You can follow him at Canny4. Long-term trader, has a lot of information about the market, good insight, good wisdom on the market. So let's see what Tom has. To say today. Trading is very long-term successful. So if you're planning on doing this for a long time, pace yourself. We carry our stress with us as it accumulates, and at some point, our mind, body, and spirit will push back. So it is essential to build in recovery time along the way. And, the reason I wanted to talk about this today is it's very pertinent to what's going on. I mean, the market's been a hot mess, right? It's literally out of its hairdo, right? I mean, I think even that is an understatement. And it has been extremely stressful, depending on your style of trading, but it's definitely been stressful for me. I can tell you that. Not so much on my swing trades, but on the day trades, because it's just been so wild. And he's right. At some point, all that stress and emotion builds up and kind of takes a toll on you. And so if you do want to be a long-term successful trader, like Tom says, you need to build in some recovery along the way. If you're a weightlifter, right, power lifter, how they will do one body part every other day. They just don't want to stress it every day. It's kind of like that with trading. So it's important to find some peace and some relaxation and recovery along the way if you want to do it long term. Because if you want to do it short term, or if you want to do it long term, but you're battling every day, it's going to be short lived. I can promise you. I've done this for so long. So try to find a balance and maybe take a day off, take some time off, go on a walk, do some deep breathing. But life's not all about trading, right? It's an important, we all love it, or we all hate it and love it at the same time, right? But it does wear you out, and when you get worn out and the stress starts to carry itself in your body, I mean, it builds up and it takes a toll, and it will make you a worse trader. I'm telling you this from experience. So do yourself a favor, take a little time off, make it sustainable. I always talk about one trade, each trade is just one of the next 1,000 trades. It's really true. Don't try to force it. Don't try to make it all in one day or 1 month or 1 year. Look at it as a long-term endeavor and pace yourself. So let me read it one more time. Trading is very long-term stressful. It is. So if you're planning on doing this for a long time, pace yourself. We carry our stress with us as it accumulates, and at some point, our mind, body, and spirit will push back, and it will. I promise you. It will manifest itself in something. Health problems, emotional problems, something. So it is essential to build in recovery time along the way. And in this market, where there are a lot of losses, it's even more relevant. When you're making money all the time, not as stressful, right? I think you'd agree with me. But when you have these big drawdowns and big up moves that get taken back away, it's stressful. So find yourself some recovery time and pace yourself. All right. Thank you, Tom. And please subscribe to Tom at Canny4. All right. Let's do a little trading poem before we start looking at my potential setups for next week. This is from my good friend Frank. You can follow him on Twitter at FrankOD. In today's market poem, it's impossible to trade without any pain. Boy, that's true. Unfortunately, losses offset hard-earned gains. Traders need an edge to take on the risk that is their bane. Flowers can't grow without a little rain. So true. Let's break it down. It's impossible to trade without any pain. I wish this was not a true statement, but it's true. You're never just going to have winners. You always have to deal with the losers as well. Unfortunately, losses offset hard-earned gains. The hard-earned gains that you had that you're so happy that you had, and then the loss comes and just wipes it all away. Not fun, but it's true. Traders need an edge to take risk on that is their bane. Very important that you need an edge before you put your money at play. You need to, if you're going to bet money on something, there needs to be some probability higher than 50%, then it's going to go your way. So traders need an edge to take on the risk that is their bane. Flowers can't grow without a little rain. So, we're flowers. We're hoping to grow in our trading, but there is going to be a little rain. But I guess you need a little rain too, right? You need the good with the bad. So please follow Frank at FrankOD over on Twitter. All right. So, as I mentioned at the beginning of the podcast, I have some daily setups possible, and I actually have some weekly setups possible as well. All right, here's Apple on the daily. Man, Apple, I remember on Friday it was down almost $5 at one point. We had this nice rally. We rejected the 200-day moving average and came right back down. Big gap right here. There's not a lot right now going on with Apple, but I look for a reason to get into Apple anytime I can. It's not quite there yet, but you can see we have a low here. We had the lows here with the deep red MACD bars. We're not quite as low, but you can see the MACD bars are not as deep as they were over here. And so if we move lower and test this previous low, we will have a double bottom and a bullish divergence, but that's not enough for me to get in. That's a big picture kind of situation where I go, okay, we're running out of some sellers, but I still need an entry signal. What would my entry signal be? Well, the 200 and the 300 and the 250, everything's above. So really what I'm looking for next week, if it happens, I don't know if it will happen. I hope it doesn't happen, right? Because I want the market to go up. But if I could buy Apple at an under 30, over 30, I would. You can see over here on the 3rd, we did have an under 30, over 30, and that one worked out pretty well, right? But I like this one even better if we get an under 30, over 30, because we would incorporate the double bottom with the bullish divergence as well as just an under 30, over 30. So to sum up, on Apple next week, I'm just looking for an under 30, over 30. Be nice if it does go down, if the under 30, over 30 happen here in conjunction with the negative third ATR channel. About 92% of prices stop going down, I should say, at the third ATR channel, or at least go sideways. And you can look in the past. I mean, back here, look, we got to the third, we bounced. We got very close to the third here, we bounced. So a confluence combination of indicators lining up here with a negative third ATR channel and an under 30 over would be pretty sweet. I don't know if we'll be able to get that or not, but if we do, I am definitely buying Apple next week if we get an under 30, over 30. Amazon, whew, what a train wreck. What a train wreck. Look at this big gap right here. Hopefully that baby will get filled. We're at a 2664, so we are under 30 RSI. So no-go zone for me. We're under the negative third ATR channel. That is going to act as resistance. Next week, if Amazon got above the 30 RSI, and also we're at 2664, so if it got above the 30 RSI, that would be my entry signal. Ideally, if it got above the negative third ATR channel, that would make it even better. So next week, I'm looking for an under 30, over 30. We already are under at 2664. Just looking for a close above the 30 RSI and ideally a close above the negative third ATR channel as well. That would be a confluence of signals and would give me support of the negative third ATR channel below me instead of resistance above me. So under 30, over 30, and negative third ATR channel is what I'm looking for next week on Amazon. Google. Yep, GOOGL. Well, this was a legitimate entry signal. This is exactly what I'm talking about. Look, let's go to Thursday. Thursday on Google, we were at 29.18. Can't buy. Friday, look, closed at 35.40, and it did close above the negative third ATR channel. So looking at Amazon, if we go back to Amazon, we're at 26.64 underneath the negative third ATR channel. Alphabet did exactly what I want Amazon to do, but I didn't buy Alphabet because I bought the other two positions, right? I bought the GDX, and I also bought the Microsoft as well because on the weekly with the 200-week moving average. Ideally, I would rather have a trade off of the 200 or the 250 or the 300 than I would the 30. Ideally, but I'm still going to take 30 RSIs if they're good. But I didn't want to buy too many positions on Friday because I already have, AMD, I already have some tech, and I didn't want to get too heavily weighted that way. But so for next week on Alphabet, if we were to go below 30 again and then close above 30, ideally with a higher low under over 30, then I would buy it. Remember, lower lows tend to move up and then fail and come back down. Higher lows tend to trend and have a better chance of having an up leg trend, and that's what I'm looking for. So I did not buy Alphabet. This was a legitimate entry just based upon an under 30, over 30, and under negative third, over negative third. But I didn't want to have too many correlated trades. But next week, If we get another under 30 over 30, that's a higher low under 30 over 30, then I'll buy it. And again, in my course that I teach that I'll talk about at the end of the course, we go over all the rules ad nauseum, and I don't expect you to understand, from this particular podcast, all the nuances of it. But nonetheless, if we get a higher low under 30 over 30 next week on Google, I will be getting long Google. Netflix. Well, Netflix has been quite strong compared to the rest of the market. We had this huge rally. They had decent earnings. Investors liked what the earnings were and the subscriber growth. Well, we went up and we had this big pullback. We are now closed under the 200-day moving average. Well, if next week we had a close above the 200, that would be my entry, right? I want to have that 200-day moving average as support underneath me, not resistance above me. I like the confluence that we had. It's nice, big, strong move up. Yes, we did have a pullback, but we had a pullback into the value zone, right? I'd rather buy undervalue, sell above. I'd rather buy undervalue, sell at value, or buy at value, sell above value. What a lot of people do is they buy above value, and when it gets back to value, they sell. Well, you should do the opposite. You should wait for it to be above value and come back into value. But then, what is your entry signal? Well, entry signal would just simply be a close above the 200-day moving average. If it doesn't close back above there, then I'm not going to buy it. I'll wait for it to come back down, maybe look for an under 30, over 30, something like that. So, but I do like Netflix, watch it all the time. And if I could just get a close above the 200-day moving average next week, that would be my entry, and it would also be my end of day stop. TLT or bonds, boy. I highlighted this here. This is called an abandoned baby or a island reversal. Island reversal or abandoned baby happens when you have a low. It can be a high as well, but you see how we have a gap down and then we have a gap up? That's a pretty strong signal that the bottom is in, and I'll show you the same thing when we look at UUP, which is the US dollar. So this particular trade can only happen for me on Monday. If Monday we get above 93.83, this will become a V2 entry. Here is bar 1. Bar 2 goes below bar 1's low by a quarter ATR, but in order for this to be a V2, the next bar or Monday has to close above bar 1's close of 95.83. So this is a little different. I don't think I've ever even really highlighted this particular trade on this podcast, but this is a one-day trade only for me. If on Monday we close above 95.83, that will give a V2 entry. And it will be a higher low V2 entry than this low. So if it doesn't close above here on Monday, then the whole trade's off for the rest of the week, doesn't matter. But if it does close above here, then we will have a V2. Bar 1, bar 2 goes below bar 1's low. Bar 3, if it closes above bar 1's close, would form this little V, this V2. I like that MACD is positive. Yes, we've had a move up, which is to be expected. We'd have some that it would retrace and come back down. We're right at about 50% Fibonacci from the low to the high that we've retraced, so that makes sense. And again, I like the MACD. So one day trade on Monday, if and only if we get above 95.85, I will go long. If that happens, then halfway of the washout bar would be my stop. Right here, about 94.85. And so I would place my emergency stop, and then my end of day stop would be a close below halfway of the washout bar, or halfway right here, roughly just a close below 94.85. Tesla. Well. I remember watching Tesla on Friday during trading, and it was way up, and then it just ended way back down. So double bottoms, bullish divergences. Take a look here. Here we have our lows. Deep red MACD bars, clearly, right? Deep red. We rallied into green. Now, this is not a double bottom yet. We have to come down and test this low first, but I can already tell, even if we come back down on Monday and test this low, there probably won't even be any red bars there, let alone shallow red bars. Shallow red bars would be fine too, but honestly, I can just tell from experience looking at this, if we come and test this low, well, here, let's do it. I have this little function here on Trade Navigator, which is nice. So if Monday we come back down there, test the low. See how there's no red? That would be a double bottom bullish divergence with a missing right shoulder. And that's what I learned from studying one-on-one with Dr. Elder. He thinks that's one of the strongest technical indicators in trading. And with this nice little function that I have here with the what if bar, I can move it down there. So yes, so Monday, if we get down to this particular low, see how there's no red there? We're at equal lows. This was a lot of red. We're at equal lows, no red whatsoever. So, and again, just because you have a double bottom bullish divergence with a missing right shoulder does not mean you can just enter. You still need an entry signal. Well, look, we're 34.85. Oh, let me get that back up and redo it and see what that would be. So Monday, if we got down to the previous lows, okay, it would bring us to 31.30. So essentially Monday, we are going to have to get to about 194.82. I'll put a line there because that's essentially just a touch above that. Yeah. So right there. Yeah, that makes it easy. So on Monday, but this only goes for Monday, if we go down, get to 195.60, we will have gone under 30 RSI. But if it closes, if it goes below 195.60, but then closes above 195.60, we would have an under 30 over 30 in conjunction with the double bottom bullish divergent missing right shoulder. So that 195.60 number is only valid for Monday. But I'm definitely going to be watching this. This would be a huge double bottom bullish divergent with missing right shoulder. Just looking for the entry trade. Would just be any time next week under 30 over 30. I would buy Tesla. All right, here's dollar. Boy, interesting. So the dollar, you know, I know in previous podcast I was telling you that this big move down, if we rallied into halfway of this big bar down right here about 30.94, that from a Fibonacci standpoint, it would probably reject that and move down. That's exactly what happened. It got a little higher, but then moved down. And then I think in the last podcast when it was right there, I was like, I think that's it. And that was it. So why is that significant for equities? Well, when we were talking about bonds, we were talking about that abandoned baby or the island reversal. Well, we got an island reversal on UUP. Look, here's the high. See how we gapped into the high? And then we move down, we gap down. See how it's just abandoned up here? That's bearish for the dollar. And what's bearish for the dollar is going to be bullish for stocks and bonds and commodities as well. So this gives me some hope here for the market that this happened with the dollar, because a strong dollar right now is not the market's friend. So if we were to get back, for some reason, if we had a rally back up to the low of the abandoned baby here, right about 30.70, I would go short. My stop would just be a close above this high if I was wrong. But we could get a rally back up there. But this is one of the few shorts that I've been looking at lately. But I would short the bottom of this abandoned baby or this island reversal here. My stop would be a close above that high. And then, of course, I would place my emergency stop 2 ATRs above, just like I do in a long trade. I would place my 1.5 ATR trailing stop level 1.5 ATRs below. I know there's a lot of terms. I know it can sound confusing. I totally get it. I mean, this is my world, so it makes all sorts of sense to me. But again, if you're interested in learning all the nuances of this, I'll talk about the specifics of the course at the end. But I think this island reversal bar and this abandoned baby here is at least a positive sign for equities, because literally in this environment, the lower the dollar goes, the higher, the lower the dollar goes, the more bonds are going to go up, interest rates would go down, and would be better for the market. So those are the daily trades. Apple looking for an under 30 over 30. Amazon looking for an over 30 and an under and back over the negative third ATR channel. Google already valid right now, but for next week to get another chance at it, I'd want another under 30 over 30 that's higher low under over 30. Netflix simply a close above the 200-day moving average. Treasury bonds, this can only happen on Monday, have to get above 95.83. That's what would get me long on TLT. Tesla, looking for a test of that low and then an under 30 over 30 as the entry signal. And then UUP, abandoned baby, island reversal, looking if we do get a rally, which I hope we don't, but if we do, and get to the low of the abandoned baby bar right about 30.27, I would enter a short with a stop above the high, and of course the 2 ATR as well as the emergency stop. All right, let's switch over to the weeklies and take a look, see what's going on for weekly. Again, weeklies, this will only be valid next Friday if what's going to happen happens. All right, so here we go. Amazon again, on the weeklies, we're at a 34.14 RSI. We do have a double bottom bullish divergence on the weeklies. Here's the low, deep red. We rallied to green. We are now lower than this low over here, but you can see the red bars, even though they are red, they are not as deep as the first, so that we are in a double bottom bullish divergence right now. But even though you have a double bottom with the bullish divergence, you still need an entry signal to base everything off of, and we're not there yet. We're at 34.14. So next week on Friday, if we go below 30 RSI on the weekly charts and back above, that would be an entry signal for me. You can also see the negative third ATR channel down here is important. So if we did get under 30 RSI on the weekly, we would also get under the negative third ATR channel. And then if it closed back above 30 RSI, it would also close back above the negative third ATR channel most likely as well. So that's what I'm looking for essentially next week, an under 30, over 30 situation on Amazon on the weekly. I would get long Amazon if that happens. DDM is double leverage Dow Jones. So essentially this is just twice the Dow Jones Industrial 30. You can see we did close above the 200 week moving average and had that big week up next week. We are currently still above the 200 week, so no position here. But what I'm looking for next week is if we come back down, either close under the 200 and then close back during the week. If we close under the 200 and then back over the 200, that would be my entry, preferably as close to the 200 week moving average as well, to give me a better risk to reward ratio. So again, we are above the 200 week moving average next week. If we come back down, touch it, bounce, that would be legitimate. Or if during the week next week we go below the 200 and then close back above the 200, I would buy it. And you might say, Greg, it's above the 200. Why don't you buy it now? I could, but the risk to reward's not that great, right? Look at the risk I have from here all the way down to here. That's a lot of risk. Let me just kind of juxtapose that to the weekly trade on Intel. See how close I was to the 200 month moving average on Intel? Just barely above it. So if it barely closes below it, I barely lose any money, right? So if we go back to DDM, if we go back to DDM, yeah, it's above the 200. I could buy it, right? But the risk to reward's not good. I'd rather have a close. I'd rather have a rejection of the 200 and then barely close above to give me that good risk to reward ratio. Google. All right. Well, Google was a legitimate entry on the daily, and it's also a legitimate entry on the weekly Friday. See how we just barely went below the 250 and closed above? I could have bought that, but I bought Microsoft instead, and I felt like the Microsoft chart was stronger than the Google chart. But still, it's Google. I would like an opportunity to get in this. So next week, a couple different things could happen. One, we could close over the 200. That would be valid as long as it wasn't too high above with the bad risk to reward ratio. Or it could retest the 200 again as well, or it could retest the 300 week moving average also. But this would have been a legitimate entry on Friday because it intra-week rejected the 250 and closed above. But again, I took Microsoft, too closely correlated. I'd be happy to take Google if it got above the 200 week moving average, because if it did, then my Microsoft trade would be positive, right? So ideally, the ideal trade here on Google for me would be the 300, right? We're at 33.09. We haven't gone under the 30 RSI, but if we went down under the 300 week and back over, it would also take us under the 30 RSI most likely and back over. So essentially what I'm looking for next week is either a close above the 200 week moving average for an entry, an under 30, over 30 RSI as a secondary entry signal on the weekly, or some type of rejection of the 300-week moving average. And ideally, if I could get an under 30, over 30, and a rejection of any of these moving averages, that would be the most ideal. And honestly, probably the most ideal would be the 300-week moving average. And I hope it doesn't go down there, but if it did, I would definitely be buying. Qs. Okay, well, I had the losing trade on the Qs, but going forward, similar to Alphabet, similar to Google, if next week we close back above the 200-week moving average, I would buy it. If we rejected the 30 RSI on the weekly, I would buy it. Here's also the 250-week moving average. If we had some kind of during the week under the 250 and back over, I would buy it. And lastly, 300-week moving average here. Man, I hope it doesn't go down there, but if it does, I promise you I would buy it. So 3 different potential entries for me on the Qs next week. If we move up, close above the 200, that's 1. If we reject the 250-week moving average, that's 2. And if we reject the the 300-week moving average, that's 3. And if I could get an under 30, over 30 in there, that would even make it better. S&P on the weekly, of course, this is the SPY. Similar to the Dow, you can see that the Dow and the SPY are much stronger than the NASDAQ just by the fact that they're over the 200. SPY, if we came back down, went below the 200 week, but at the end of the week closed above, I would certainly buy the SPY based upon that. Or if it goes further, rejects the 250, I would buy that. If it goes further, rejects the 300, I would buy that. And then last but not least is XLU. Utilities, again, we are above the 200-day moving average. If next week we came back down, had some kind of rejection and closed back above the 200, I would buy it there. If it went lower, had some rejection, closed above the 250, I would buy it there. If it went lower, rejected the 300, I would buy it there. So it's very important in this market that you position size based upon volatility. I showed you doing that, taking your maximum allowed loss divided by the 2 ATR. And having levels, lines in the sand that you key off of. So those are what I'm looking for next week. You know, at the beginning of the podcast, I talked a little bit about lessons. Listen, if you want to learn how to trade the way that I do, and I teach 5 different trading approaches, all you have to do is contact me. The email is in the link of this YouTube video. Just send me an email, say, Greg, I'm potentially interested in taking your course. I'll reply and say, great, that's wonderful. Why don't we do a Skype call? It's a free Skype call. It's not a sales job. I promise you. It just, sincerely, honestly, I just like to meet my potential students. I like to ask them questions about their trading. What are their trading challenges? What are their goals? What are they expecting to get out of the course? And then it's a great time for them to ask me any specific questions you have about the course. And when we're done with the call, that's it. You're going to have to contact me in the future. It's not like I'm going to follow up. Hey, do you want to take the course? I promise you, I have more stuff to do than that, right? But I do like to get a feel of my potential student, and it's a good time for them to ask me questions. So the course costs $1,750, but it is 15 hours of one-on-one instruction. I teach you step by step. It's very important to me that my students succeed and become great traders. I mean, it's extremely important to me. That's why I started this podcast, because if you know my story, I lost a lot of money when I was in my 20s, and I spent 20 years studying trading. I want people to really learn how to trade correctly, and that's what I have in my course. So if you're interested, just send me an email. Email's in the link in the description. I also have an online course, if that's more your thing. It's a great course. It's very affordable. It's at udemy.com. I have a link in the description. It's called the Deep Dip Buy Stock Trading Strategy. And almost all the entries that I showed you here in this podcast today are based upon that trading strategy. And that the cost of the course is $12 to $15, but there's so much content in that course. There are 9.5 hours of video. There's 26 total videos. There are 15 study guides, and I do teach you step by step how to trade that. Trailing stops, emergency stops, profit targets, all sorts of stuff. So the link's in the description. If you have 12 or 15 bucks kicking around, I promise you it's worth every penny. I've got so many good reviews and so much feedback on that. And 2 more things, the most important things. The next one's not the most important thing. The last one's the most important. But number 3, if you like today's podcast, really would appreciate it if you could hit the thumbs up button, maybe share it on social media. By doing that and hitting the thumbs up button, it just lets YouTube know that there's some valuable content here, and they're more likely to get it out to more people on the YouTube platform. And there are a lot of people out there that could use a little help with trading right now. So you could help me, help them. All you have to do, just click the thumbs up button. It's free, and I would really appreciate it. Okay, here's the most important thing. Try to go out, do something nice for someone today. You know, in this world, if we all did just one nice thing for another human being, it would make the world a better place. And I think we need the world to be a better place. I mean, it just seems like a hot mess right now with all sorts of stuff. And why don't we just have it start with us? Whether you just hold the door open for someone, just say some kind words, be there to listen, give them a bite of your donut, whatever, right? Just one nice act of kindness would make the world a better place. It's going to be good for them. It's good karma for you. And if you could also go out and do something nice for an animal today, even better. Animals appreciate kindness. They appreciate kind words, good feelings. And I grew up with all sorts of animals, ducks and ponies and cats and dogs, and I was very close to animals my whole life. I still am, and that's why I always try to put this little plug in. Try to do something nice for an animal today. One nice thing for a human, one nice thing for an animal. So let's see what happens next week. It is a crazy market. I hope you're staying safe. Just the best advice I can give everyone is just pick a level, and if that level is breached or violated, just get out, right? There's going to be other times to get in. And, you know, we're kind of in an unprecedented situation here with these interest rate hikes and all this kind of stuff, inflation. So please be careful. But again, in these situations where everyone's super negative, it's also, there's opportunity here as well. So I hope you have a good rest of your weekend. I really do. And I will see you next week, and have a good week. Be good, be safe, be careful, be good to yourself in life, be good to yourself in trading as well. And on the way out here, I have to run the U.S. legal disclaimer. But thanks again for coming, everyone. Appreciate you spending your time, and we'll talk to you, God willing, next week. All right, take care. Bye-bye. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much. U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation, and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.